This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 310. And Ben, you and I were just laughing about how our guest characterized herself as a boring economist. And you and I agreed, and I'm sure the audience will agree, that this conversation was anything, and she is anything but boring. What a great conversation with Professor Antoinette Schoar, who is the Stewart C. Myers-Horn Professor, Family Professor of Finance at MIT Sloan School of Management. And this is a super wide-ranging conversation about all sorts of topics, and you have to give the backstory. I know I always ask you this, but there's always a backstory to these conversations, and you got to carry it from here.
I don't know.
Great.
I don't know how much of a backstory there is, other than I've been aware of Antoinette's research for a long time, as I think anyone that's studied financial economics would have to be, because she's done sort of groundbreaking research on private equity. But she's also done stuff on entrepreneurial finance, fintech, consumer finance, financial intermediation, household finance. We spend a lot of time talking about, but tons of huge research, big influential papers. So that, I mean, I just knew we had to have her on eventually, and finally asked her to do it. We did have her co-author on some of her more recent research on crypto, Igor Makarov, on the Rational Reminder when we did our crypto series. So there was another instance of me being aware of Antoinette's impact on financial economics. But yeah, I agree with you, Cameron. This was an awesome conversation. I mean, I was thinking as we were finishing the conversation how grateful I am to be able to talk to people like that.
Oh my
because
gosh.
of the podcast. Like,
Absolutely.
It's just, I don't know. Like, you don't talk to people like that in normal day-to-day life.
Yeah.
You know, you just don't.
And listening to people like her, and she said it, financial literacy is so important, especially in the decision of how you choose your financial advisor to make financial decisions. Great research on that. Talked a lot about target date funds, perception of risk and house prices. Fascinating research there.
It's all fascinating. And I really appreciated how when we would ask a question about her research, that we had clearly read the research and understood some of its implications and asked a question based on that. She loved it. Like she's excited to talk about her research, which is just so cool. I mean, I think all of our guests probably are excited to talk about the research, but I don't know. I just found it to be a very energizing conversation on some really cool topics too. I mean, we had target date funds, like you said. We had how people's beliefs, how an individual's beliefs affect the way that they respond to new information, which is also just fascinating to think about, how people make decisions. And then there's some on the perception of house price risk and how that affects the rent versus buy decision. That was also super interesting. And then a bunch on, she got two papers on financial advisors, one that's been out for a while, and one that I don't even know if you can find it online yet. But when I sent Antoinette my first pass at questions, she was like, "Oh, well, you should look at this, like brand new, hot off the press paper too." I was like, "Okay, awesome." So we asked about that one.
And then at the end, you snuck in a couple of questions on private equity. And
yeah, private equity. Well, crypto too. We had a whole section on crypto, and her thoughts on that were super interesting. And then snuck one in on private equity, which, like I mentioned earlier, that's an area that she's done some great research on, both in the past, but some more recently too. Anyway, wide ranging in terms of the topics, but I think this was a great conversation that I think the listeners will thoroughly enjoy.
All right, good to roll?
Yep.
Here's our conversation with Professor Antoinette Schoar.
Antoinette Schoar, welcome to the Rational Reminder Podcast.
Thank you for having me.
Super excited to be talking to you. Antoinette, to kick it off, how important to have target date funds become to the American retirement system?
Actually, quite important. And it's almost a little bit of a serendipitous situation that, they were introduced as a solution to a default allocation in 2006 and have grown from there, but they really have had a very successful rise since then.
And how have target date funds affected the proportion of wealth that households invest in the stock market?
That's actually a very interesting question, because you see, they haven't necessarily affected how much people put into retirement savings. According to research I have done with my colleague Jonathan Parker and a PhD student of us, Alison Cole, we actually see that they don't necessarily increase the amount people save, but the way they people allocate their retirement savings. And it has led to a situation where basically people are now, especially in young age, putting more money into the stock market, therefore, in a way, taking more risk. And when people become older, these retirement saving target date funds automatically allocate more and more into less risky assets like fixed income. And so we see basically that with age, people are therefore then allocating more to bonds and fixed income and less into the stock market. And that has changed really dramatically since the introduction of target date funds.
So it hasn't affected savings behavior, but it's affected asset allocation behavior. What were people doing before? Like, what's the difference?
Yeah, the difference, interestingly, was that before, so say before the 2000s, people didn't really reallocate their savings over their life cycle. So even say older people that were close to retirement, in a way, got stuck with the same allocation that they were in when they opened the account. In addition, we also saw that in the past, people actually allocated much less on average to equities. So, in the pre-2000 period, lots of people, or the average person, had more around 40 to 50% of their retirement savings in equities. And we are finding that people have almost 70% in equities nowadays.
Interesting.
Very interesting.
Probably a good thing, right?
Yeah, I mean, so it's a good thing in the sense that, we know that there's an equity premium, right? So because you're taking risk when you're investing in equities, on average, investors want to be rewarded for that risk that they take, and therefore, are expecting to have a higher return on the risky part of their portfolio. Now, of course, they're taking risk. If you are unlucky, and we have seen, right, that unfortunately the market sometimes goes down, and if you are hit with one of those negative shocks close to your retirement, then you have very little time to make it up if you want, right? And that's why we often think that it is sensible that people take less risk when they approach their retirement age.
How have the target date funds affected the trading behavior of the retail investor?
Yeah, so actually, at least according to our research, not so much. And this might be, it's somewhat surprising to you, but the reason is the following. The average American, unfortunately, actually, looks at their retirement savings, right? Their 401k, very rarely. In fact, we find that people actually log into their retirement accounts as little as, on average, once every 1.5 years. So that's shocking, right? I mean, so they are definitely, people are not day traders in their retirement savings accounts. In fact, I would say they may be even looking at it maybe a little, too little, right? Because you want to be aware of what you're doing in your retirement account. Now, of course, there are people, right, who have brokerage accounts and so on, and they are trading quite a lot in those accounts. But in their retirement in 401ks, it hasn't affected people's active trading. But you see, in a way, the target date funds were meant to help with the fact that people pay so little attention to their retirement savings. And what the target date fund does, right, is that when, say, the stock market goes up a lot, it automatically rebalances you out of stock and into a little bit out of stock, right, and more into fixed asset, so that you're back to your target allocation for your age group. Right. And so given that we see, even in our data, right, that in the past, people didn't do that. So when the market, say, would go up a lot, they were suddenly very skewed towards equity. Or when the market went, the stock market went down a lot, they suddenly had very little in equity. And that's obviously not so.
Interesting. So basically, people didn't used to rebalance, and now they do.
Exactly. It helps them, right? They're not doing it actively, but they're being helped in doing it.
That 1.5 year number is a staggering statistic.
Yeah, that is.
The average is 1.5 years.
Yeah, it's staggering indeed. Unfortunately, you see, there is also, in our data, right, at least this research that we did, it's all people that have a 401k. I can tell you, I've talked to a lot of 401k providers, and they also say there are people that are so maybe uninformed, or, they don't get their act together, and they don't even open a 401k, right? And if you don't, even if you are at an employer that has a 401k and has a match, right, then you are really losing out. And those are things that, ERISA, which is the regulator of the retirement savings accounts, right? Retirement savings system, but also the 401ks, by allowing more default allocations to target date funds, again, is trying to help people to start investing, even when maybe they themselves wouldn't allocate the money in a smart way otherwise.
What about mutual fund flows? How have target date funds affected that?
Yeah, so that's a great question. At least, it's something that's very close to my heart because I've been doing research in it. But actually, what's interesting is if you think about what is a target date fund, right? A target date fund is almost like a construction on top of a set of mutual funds that are equity and fixed income mutual funds, right? And what the target date fund does is, as we were just saying, it rebalances you in actually a counter-cyclical way. So if the stock market goes up a lot, right, and without rebalancing, you would now be too skewed towards equity. What then happens is the target date funds sells some of the shares from the equity mutual funds and buys a bit more from fixed income, right? And the other way around, if the stock market goes down, and therefore you now have less money than you should in terms of, kind of portfolio balance in equities, it actually counter-cyclically buys equities when the market has gone down. That's actually completely the opposite to how the typical retail investor invests in mutual funds, right? We know from a lot of research that retail investors chase returns, meaning that they actually start buying more equity mutual funds when equities have done well, and the other way around, right, when equities have done poorly. And so it has really changed the flow behavior into mutual funds.
How have they affected individual stock prices?
That's also a good question. So what we find is actually so this is, it's of course a market, right, is there's demand and supply, there are changes in prices, so it's an information that people have. So it's not so easy to estimate how some flows, such as targeted funds, affect stock prices, individual stock prices. In aggregate, anyway, is very difficult typically to estimate, right? Because so many things go on in the market all the time. But one thing that we were able to exploit in our research is that actually target date funds tend to be skewed in the stocks that they allocate towards to larger and more liquid ones, right? So they are more likely, say, to be heavily invested in S&P 500, in the, kind of basically largest and most liquid stocks. And so what we are then able to do is to look at stocks where target date funds became really important holders of those stocks and compare them to stocks where target date funds are much less likely to allocate to. And what we see is actually that even in the, just in the last 10 years, when target date funds were growing quite a bit, we see actually that the stocks where the target date funds are very prevalent, their returns are actually now much more stabilized. So basically the up and down, right, the movement with the market of those stocks is muted for those that target date funds are holding. And that makes sense, right? Given what we just said, is that because target date funds counter-cyclically invest money when the market is down in equity, right, and sell equities when equities just have gone up a lot, that then it would make sense that we would see that type of pricing behavior. Yeah. In other ways, you could almost say that it has muted the type of momentum that, kind of the type of market-based momentum that we see often, for stocks where retail investors are chasing return.
Would the price effects from target date funds create any arbitrage opportunities?
That's a very good thought. So we looked into this, and ex ante, it could have been, right? But we couldn't find. I mean, so what we at least show in our research is that for the last almost 2 decades, when target date funds were growing, if you were trying to trade against the target date funds, you would have actually lost money. So, kind of, now, of course, who knows, right? Going forward, if they become even bigger and maybe their price impact becomes even stronger, that could change. But we didn't find that you could really arbitrage against them.
And what effects do they have on market efficiency?
So we can only speculate a little bit about this, but it's actually not clear whether they are helping or hurting efficiency. And the reason why I'm saying this is the following. If you think, right, that some market movements, or let's say it this way, in situations where market movements, price movements, right, are based on price revelation and new information, the fact that the target date fund trades against those price shocks actually makes it harder for the information to get into the market, right? And in those situations, actually, they would make markets less efficient because it becomes slower for the price to move where it needs to move, yeah? But if you think that there are also situations where the market sometimes overshoots, right? Or there is basically, behavioral reasons or meme stocks. I mean, obviously, there are very few meme stocks, obviously, right? But they can be cyclical movements. Then it might be actually that target date funds increase market efficiency because, right, then they are leaning against these type of overshooting behaviors.
We had a recent guest who drew the distinction between market efficiency and market elasticity, and he was talking about his concerns with the growth of index funds in particular. How do target date funds affect the elasticity of aggregate demand?
Yeah, so we, at least in our research, we have basically we think that it actually increases the elasticity of aggregate demand because there is now much more rebalancing in response to price movements.
Yeah, that's very interesting.
What do your results suggest about the future of, momentum or other trend chasing anomalies?
Yeah. So at least in the time period that we have looked at, it seems to actually lean against this type of price chasing behavior. And we think that, if targeted funds grow even more, it could even be stronger. Despite what we just discussed about, does it affect market efficiency and so on, I think for the average retail investor, typically, this type of momentum chasing and trend chasing actually has been shown to not be necessarily good, right? They actually lose money this way. And so I think it's probably on net better for retail investors if they are not return chasing and rather have a more automated solution that helps them rebalance where they maybe actively wouldn't do it.
Oh, that's interesting. So target date funds might kill the momentum anomaly in the data, but overall is better for retail investors because momentum exists due to return chasing, which is probably destructive to the individuals doing it.
Right.
Wow.
Exactly. Yeah.
So interesting.
Yeah, that is super interesting. Okay, I want to move on to some other research. How do people's individual beliefs, like their political affiliation, which you look at in a paper, how does that affect how they change their portfolio in response to new information?
Yeah. So what we looked at is actually political elections, basically presidential elections in the US. And exactly as you just said, Benjamin, political election like Obama being, kind of elected or then Trump being elected, right? These are information that in a way, everybody in society learns, right? This is not a situation where somebody has, preferential or private information. And that's why we thought it was interesting to look at these highly publicized events where the information itself is available to everyone, but different people might react differently to it depending on what their prior is about, maybe, right? The type of political, the type of economic policies that, say, a Republican or a Democrat with big D and big R, president would enact. And what we find actually is that, if you look at we looked first at the Trump election in 2020, and we see actually that people who are democratic leaning and people who live in zip codes that are heavily democratic voters react to the news of Trump being elected by pulling out of the market. And Republican leaning voters and investors are moving into the market more. Now, what we thought was interesting about this is actually remember what we said before, how little people look at 401k, unfortunately, actually. In this case, maybe it's a good thing, because what we see is that it's about 10% of the population reacts really strongly and pulls actually quite a lot of money either out of the market or into the market, right? The majority of people doesn't do very much. What I thought was kind of interesting is if you look at opinion polls, like, the Michigan sentiment survey and so on, when Democrats and Republicans are asked about how do they see the future of the economy, right? Like in response to these political elections, right? When Trump got elected, Democrats were like saying it's the end of the world, and Republicans were saying it's the second coming. And then, if you look at the similar thing, when Obama was elected, just flipped, but the same thing. But interestingly, right? What I think is is quite interesting is that it seems to me it's probably cheap talk how you answer a survey question, right? It's easy to say in a survey question, oh my God, this is the end of the world, or this is whatever. When you have to put your money, right, where your mouth is, it seems people are much more careful. And and maybe that's a good thing, because in the end, it shows that, people in the things that really matter have a slightly more balanced view of what different presidents mean for the economy. Yeah. The other thing I just want to say, which we also thought was interesting, is women, because in general, women's political beliefs don't seem to be as strong, or maybe as ideological, as men are. They also react less in this polarized way in their savings behavior. So they are in a way much more moderate also in how they react to these political information.
Wow.
So how can people avoid letting their beliefs get in the way of their financial decisions?
Yeah, wouldn't we all like to live in a world, not just in savings, right? I think it's being wiser, but this is not a finance answer, sorry. So, in finance, I mean, what we see in the data is actually two things. We do see that people who use financial advisors tend to react much less strongly. And I think it's because, right, financial advisors are meant to indeed lean against some, biases that you might have and help you kind of stay the course more. We also, by the way, see that people who have much more money in targeted funds tend to be also less likely to be, pulling out of anything. But I think, in general, I think obviously it is, how to say, kind of, there is one thing about your political and ideological beliefs, and there is, another side is being rational about, what moves stock markets. And I do think, that's just something that hopefully people, kind of learn. And by the way, let me say one other thing. We do see that, because if you remember, right, during the Trump campaign, and then after Donald Trump was elected president, capital gains tax were reduced significantly, right? And no matter what political belief you have, you do have to understand that, say, lower capital gains tax do normally get capitalized into prices, right? And so no matter what your political belief is, right, that's something that you should react to. And we see over time, also democratic voters indeed do then start allocating more to equity again over time.
Yeah, that's all super interesting. We're in Canada, but we definitely had calls from clients when Trump was elected who wanted to go, get out of the market and go to cash. I remember that, and we were the barrier to stop them from doing that.
Yeah.
Yeah. It's super interesting research. I want to move on to perception of risk in housing. How much variation is there across households in the risk perception that they have of housing as an investment?
So that's research that kind of I have done with two other colleagues of mine, Manuel Adelino and Felipe Severino. We were very surprised, actually. So I should say this is based on survey data where the Fannie Mae has a survey, and then the New York Fed also has a survey that asks a representative set of households about their risk perception of house prices. And why we were so surprised is that the majority of households actually believes that house prices are not very risky. And that was even true because, these surveys got started after the great financial crisis. So they got started in around 2009, 10, right? And then the Fed survey a bit later. But even directly after the financial crisis, after we've experienced such a big shock to house prices, when people answered about their perception of house price risk, they thought that house prices are less risky than even mutual funds, even diversified mutual funds, and even fixed income.
Wow.
so meaning bonds.
Yeah.
And that's really stunning, right? And I think, you see, I think it's maybe that people somehow, because they might be over optimistic about their own house, right? Like you know your house, you maybe like your house, you feel that if I just keep my house in tip-top shape and my garden beautiful, right, I can always sell it, and so there is not so much risk. But unfortunately, right, the data obviously tells something very different. And so, to me, as you can hear from my accent, I'm not born in the US, right? I'm from Europe, I'm from Germany, which is a country that has a much bigger rental market. And people live very happily being renters and not necessarily having to be exposed to such a big and illiquid asset when they might be, lower middle class, and therefore it's maybe better for them to save in a different vehicle than a house, right?
I want to keep going on this rental question. How do individual perceptions of the house price risk affect the rent versus buy decision?
Yeah, we do actually see that it does. So we see that people who think that house prices are risky and have volatility, they tend to be more likely to be renters than owners. And in fact, that's even after, because there are people who are renters for completely different reasons, right? When you are young and you're still in school and you're not settled down, it makes no sense, right? If you know that in 2 years you're moving anyway, or when you have say little savings and very volatile income stream, right? You might not want to take a lot of leverage and buy a house. But even after you control for all of this, we do find that people who are in a way concerned about house price risk tend to be renters in the US. And I mean, that makes sense, of course. But in a way, there are few people who are really concerned about house price risk. A majority of people basically seems to believe that housing has very little price risk.
Could the people who think housing is not risky, could it be the like I've read about the hedge argument that houses hedge your housing consumption, so it's a sort of different way of thinking about risk?
So yeah, that could of course be true, right? If that's true, of course, right? They should be hedging rent price risk, right? But we looked at say even in neighborhoods where the rent to buy ratio is more or less favorable, right? We don't find many differences there. So we think that it doesn't really look consistent with the hedge argument. It seems more maybe that people are not fully aware of how much risk there is actually in house prices. And you see, one thing, and this is just a guess, right? I mean, this is in a way an educated guess, but I wonder if what happens is that people think about risk when it goes up frequently, and they think in stock prices, kind of there's a lot of volatility day to day and week to week. House prices, you don't see it so much, right? Because when a shock happens, it happens once in a while. But maybe what people don't take into account is that it's exactly when those shocks happen that you might want to sell. And then you cannot sell. And so it doesn't matter that day to day there's not so much volatility. It's when you need it, the liquidity is not there, right? And unfortunately, that's what so many households suffered during the 2008-2009 crisis, right? When when house prices had dropped, their mortgages were underwater, they couldn't re-lever, right? And then maybe even lost their house. So that this is obviously, kind of was a very horrible time for a lot of households.
What changes people's housing risk perceptions?
So we do find that past experience of kind of house price risk does seem to change it a little bit. There's also, kind of work by other researchers that have looked at, kind of the amount of risk that you experience early in life seem to have some formative and persistent effect on people's, in a way, aversion to these type of risks. But ultimately, it seems that at least in housing risk, they don't adjust very significantly to the actual risk that there is in this.
Wow.
How can people use this information to make better housing decisions?
So I would say what's important for people to understand is that from every research we have seen, and this is, kind of, there's a lot of research, it's not my own research, going back, of course, to Bob Schiller's work, and Jim Poterva has even work in the 1990s that shows this. So house prices, not just in the US, but actually it's really across the world, seem to have a very strong mean reverting cycle. So there tend to be these periods of exuberance where house prices really go up, and they typically mean revert. And then they go down quite a bit, and then they actually also mean revert on the way up, right? And come back up. And so I think this is very, broad advice, I know, but I think one should be really, really wary to be buying houses, especially say with a lot of leverage, and when you maybe put, a lot of your savings into it at the peak of a cycle, or when, a cycle, of course, right, you never know whether it's already the peak. We know this ex post, right? Yeah. But when a peak has been going on for a long time, it would be good to be very careful. And in fact, there's very nice work by Monica Piazzisi, for example, at Stanford, who actually looks, again, at survey data from the US. And what she shows is that if you look at the great financial crisis, in the run-up to the crisis, actually, the majority of American households by 2006, 2007, was becoming very nervous about house prices. And actually, when answering, questions about perception of future house price growth, were saying this cannot go on. But there was a small subset of the population, about, I think, 15% in her data, that became really exuberant about house prices just in 2008. 2007, 2008. And most likely these are people who then bought, right? And so I think even looking at how, say, sentiment in the population is changing can help you identify when we are coming close to maybe the peak of an exuberance cycle.
Yeah, that's interesting. I think it's looked like we're in Canada. I mentioned that earlier. It keeps looking like we're at a peak here, but I don't know if it's gonna. I don't know when it's gonna turn around. I think everyone in Canada would love to know where the mean is.
Yes.
Okay, I want to move on to you got a couple of great papers on financial advice. In your audit study on financial advisors, how well did they de-bias their prospective clients?
So we did an audit study of financial advisors in the US, where we sent, in a way, mock clients, if you want, to different financial advisors. And these different clients had different portfolios that present different biases. So, for example, some of them were return chasing, some of them were under diversified and held too much of their company stock, meaning, the company where they're working, which is not good for having a well-diversified portfolio allocation. What we saw is that financial advisors de-bias their clients when the decisions that people then would make benefit the advisors financially. So, for example, right, if a client holds most of the money in their own company stock, that is bad for the client, for sure. but it's actually also something where the advisor, by helping the client, makes money, right? Because the advisor can tell the client, move away from that one stock, diversify and buy a mutual fund, where they then benefit, right, from, kind of the compensation. Unfortunately, we saw that when clients have biases where the advice would go against the financial advisor's incentive, then they do not debias. And what I mean with this is, right, like, say there are some clients who think, you should be chasing different different industry returns or different subsets of the fund strategies, right? Those clients are, of course, in some sense, useful clients to financial advisors, because you can rebalance their portfolio all the way and push it from one type of fund to another, and each time basically get fees as an advisor. And there, unfortunately, we saw that advisors didn't give people, say, the advice to just invest in low-fee index funds, because that's not so much in their own in personal interest, right?
So that suggests conflict of interest affecting the advice.
Absolutely, yeah. You're saying it very eloquently, right? All the stuff I just said, right? Basically, yes, it means that it affects the advice. But I do want to say, because I don't want to be bludgeoning advisors either. I mean, it is true that in situations where the advice is, it doesn't lead to a conflict of interest, they did give good advice, right? And in a way, I would say that one of the problems actually is that we have, maybe in the US in particular, too many financial advisors that actually are brokers and not fiduciary advisors. And, in the US, at least, there's a difference that if you're a broker, you don't have a fiduciary responsibility to your clients, right? You just need to not defraud them, basically. It's a very minimal responsibility. While registered investment advisors, who are fiduciaries, they actually need to make sure that they put you into the lowest fee funds and act in your interest. But unfortunately, in the US, less than 10% of professionals who act as advisors are actually registered as fiduciary advisors.
Yeah. So in that audit study, how did the advice of the advisors line up with portfolio theory?
So I would say on a minimal basis, it wasn't too bad. Now, this sounds somewhat circumspect, right? But what I'm trying to say is that the majority of advisors actually did advise people to put money into mutual funds. And therefore, right, at least there was a minimal set of diversification of the portfolio that these advisors actually recommended. And so I would say, they didn't give terrible advice, right? Where the problem came is more really that they were not necessarily always putting people into the type of mutual funds that have the lowest fees. And they are erring on the side of putting people into actively managed funds. And we know that actively managed funds often have very high fees without doing better than an index fund. And so this is the margin where I feel retail investors should be very vigilant, if you want, and they should understand that typically a low-fee index fund is really the best allocation that they can do for themselves.
How do investors' prior beliefs affect their receptiveness to receiving financial advice?
That's a very good question. I would say from some of the work that we have done is that this is actually a relatively subtle answer, and the question is subtle in the following sense. you very often hear from financial advisors in the market that somehow you have to cater to people's belief. You have to basically just tell them what you want, what they want to hear.
They want to hear.
And you cannot educate people, which it's a little bit condescending, but it's also very self-serving, right? Because it basically means if I give somebody somewhat suboptimal advice, it's not my fault, it's because the client couldn't understand better. So from my research, at least, that doesn't fully line up with what we are finding, because what we are finding is that when people have more financial literacy, right, when they know already some finance, they actually want to get advice that is more aligned with textbook advice, meaning, they actually expect advisors to tell the clients that they need to be well diversified, minimize fees, not go into active funds, right? And so actually in those situations where the clients has this strong priors, it's when they are more sophisticated and when they're expecting better advice. However, what we find is that the type of client who has very little financial literacy, they actually are very malleable. So it's not the case that you need to cater to them much, because actually whatever the advisor tells them, the client is typically willing to believe. Now, for the client, that's not so good, because it means if they're getting bad advice, right, they are just moving into that advice as happily, if you want, or as easily as moving to the good advice. But actually, remember the argument we started with is that you have to give the client what they want to hear. And there the argument is no, because the client doesn't know what they want to hear. They don't have much of a prior. So they're very willing to accept good advice too, right? And so there's in a way no excuse to give these clients very biased or distorted advice. They weren't waiting for distorted advice, right? I do want to say one thing which is probably true, and that, in I've heard from many advisors, and, even I see this in my own students, right? It is true that when the market becomes, very hot, or when there is basically, certain asset classes are very bubbly, as people like to say, right? But basically when there has been a run, it is true that then there is a lot of temptation for people to, in a way, follow those trends. And I think probably it is true that a good advisor who understands their clients well does need to put a lot of effort to explain to people that now, look, these are exactly the times where being diversified and not breaking your portfolio allocation, it feels like, oh my God, I'm missing out because crypto is going through the roof, right? But if you go then into crypto, it will crash on you, right? So, kind of, and then hindsight is unfortunately very painful. And so I'm just saying that I'm not trying to say that it is easy for financial advisors to explain to people what good advice is and why you have to have discipline in your portfolio. So I'm not belittling this. All I'm saying is that it's not the case that somehow, especially financially uneducated customers have crazy beliefs and cannot be persuaded of more rational financial strategies.
So people with high financial literacy have a prior that high fees are bad, index funds are good, and then people with low financial literacy don't really have any priors and are receptive to advice. How does receiving advice change the priors of each group? Like if you take a financially literate investor who believes in index funds and put them in front of an advisor that says, no, actively managed funds are good, how does that affect their beliefs? And then likewise for people with low financial literacy.
Yeah. So what we found is that for the people that have high financial literacy and you tell them, the opposite, they actually dislike the advice. And they basically downdate on the advice and they don't change their beliefs very much. Now, for the people with low financial literacy, we basically see that, yes, they react to the advice that's given and they move their priors in the direction of the advice, whether it's, good advice or bad advice.
Yeah, it's really interesting. And then how does advice, so you did this experiment where people receive advice, and then I think there was an activity where they had to actually choose to invest their own money, and there was a prize or something, like a contest. How does the advice that they received affect how they actually invest their money?
Yeah, so we do see that the advice that they receive affects how they invest their money. And what I mean with this is that, again, we see that financially more literate people are more likely to pick index funds and low fee funds, and financially less literate people are more likely to also pick active funds and higher fee funds. We do find then, however, that the advice, people follow or change their investment behavior in response to the advice. And we think, kind of that part of the, even though people, even very educated, financially educated people, might on paper understand that you need to be diversified, that you need to pick index funds, that you need to pick low fee funds. But when given actual funds to pick, they don't necessarily what that means, right? Mm-hmm. There's a big difference between knowing that you should be well diversified and knowing, kind of how to build a truly diversified portfolio, right? Is it 10 stocks? Is it 50, right? How much do you allocate to each, kind of basically stock in the market portfolio, right? This is obviously, in a way, more difficult than just knowing the concepts. And so I think this also highlights, in a way, right, that financial education, goes a long way in helping clients and average people know what to ask for from an advisor, but they still need to rely on the expertise of the financial service industry in really implementing those strategies.
Yeah, it's a big insight. So people can get the general concepts, and that puts them in a much better position to receive advice, but it doesn't necessarily imply that they can just go and do it themselves successfully.
Exactly. I mean, in a way, and why would we expect, right? We don't expect people to do, kind of appendicitis on themselves, right? I mean, we want doctors who can tell you what the right diagnosis is and then do it for you, right? And in a way, financial services is very similar to any type of expert service.
But it does highlight how important financial literacy is for someone to be able to detect when they're getting bad or conflicted advice.
Exactly, right? Because, I think to me, this is a very important, dimension that also regulation needs to be aware of, right? Is that the market for financial advice, of course, is meant to be a private solution in a world where, financial decisions are complex, but choosing a good advisor needs already literacy, right? And how to pick a good advisor is, in a way, one of the biggest decisions that actually retail investors make. And I think, in the US at least, it's often very much left to retail investors without much help. Again, because as we were discussing before, most professionals who give advice have very minimal fiduciary responsibility to their clients.
Yeah.
How does advisor compensation affect how their advice is perceived by the consumer?
Yeah. What we find in our research, so in the US, there are different models of how advisors are compensated. A majority of advisors is basically compensated by fees that they're getting from the mutual fund providers to whom they allocate clients' assets, and that creates a conflict of interest, of course. Now, there are also models, for example, where advisors are paid just by time spent with the client. And then what you also find is, especially for much wealthier clients, that advisors are paid by asset under management. And there, the incentives are obviously much more aligned. The issue is often that, in the market for financial advice, there are lots of financial service companies that are marketing their services as saying that, the financial advice is free, but it's not free, right? Because it is paid, the advisors are paid by back-end fees that those mutual fund providers are providing to, to the advice company. And the problem is then the following. What we see in our experiment is that when customers are being told that the advisor has a compensation scheme that conflicts with their interest, they're actually reacting less to the advice. So in a way, that's very rational, right? They basically realize there could be a conflict, so I should take everything with a bit of a grain of salt. And if the advisor is very well aligned with the client, they're much more willing to believe it. So that's, again, it's great in this experimental setup. What I'm a bit worried about is that in the real world, right, where you have a lot of advisors who will market their service as if they were for free, many consumers might not understand that, in a way, you have to pay for advice. And therefore, an advisor that says, look, I do need to be paid, say, for the time I spent with you and for my human capital, right, and the effort I put, then it suddenly might seem to an uninformed retail investor, wait, this guy is willing to give it to me for free and has also a lot of beautiful slides and talk and blah.
That's right.
And this person says, I have to be paid. And then it sounds almost like this person's taking advantage of me, even though no, this is just the honest advisor who tells you how they are being paid. And so this leads to potentially leads to some adverse effects of competition in this market when customers are not informed, or fully understand how actually different advisors are being compensated.
Yeah, well, that's important.
Mm.
So consumers, given the information about how the advisor is being compensated, they'll make rational decisions in how they interpret the information, but that disclosure is not always obvious.
Exactly, right. And I think one thing that people, I know it sounds so boring and it sounds like a boring economist, right? But when you are shopping for any type of financial advice, but also maybe other advice, you have to expect that the person has to be paid, right? Most people don't work for pro bono and for, I don't know, the kindness of their heart. And I know that's what I'm saying. It sounds like the horrible economist who always, says that everything has to be compensated, but we all want to live and probably want to live well. And so why would advisors who have good knowledge, why should they give it for free, right? And so I'm just saying that, therefore, customers should always think the service has to be somehow compensated. If somebody tells me it's for free, that just cannot be true. So I need to dig deeper and understand where are they getting paid, right?
Yeah, gotta follow the money.
Indeed.
So based on the research that you've done on financial advisors, what do you think consumers should be looking for when they seek out financial advice?
Yeah. I would say, number one, as we just discussed, they should really understand how is the advisor compensated, right? What is the alignment of incentive or the conflict? And typically, it's actually great if your advisor is paid by asset under management, because then, when your portfolio does well, they do better, right? And the more they grow your portfolio, they also get more fees, but in proportion with the gains that the portfolio makes. In addition, I would say people should think about getting financial advisors whose fiduciary responsibilities are aligned with them. And of course, in different countries, I'm sorry, I don't know in Canada what the regulatory landscape is, but in different countries that means different things. But there are consumer advocacy groups, and kind of in the US, for example, there's also Consumer Financial Protection Bureau, and others where you can get good information about what are the type of compensation schemes that are available and what are the types of, in a way, supervisory frameworks for financial advisors. Yeah.
It is similar in Canada.
Is it similar in Canada?
Yeah. So over different words and different regulations, but overall a very similar setup where there are brokers who are not required to act in the best interest of consumers, and then there are specific registration categories where they are required to be fiduciaries. Yep. Okay, that's great. I want to move on to cryptocurrencies, which we spoke with your co-author on some of your research on this, Igor Makarov, a while ago. You started looking at crypto, pretty early in terms of academics who were taking it seriously. What got you interested in studying cryptocurrencies?
To be honest, actually, my students. So what happened is that, so I was also, I've been working in consumer finance and in fintech and financial innovation and venture capital for a long time. And I somehow thought, oh, this crypto thing seems like, this niche. This was like, say, in 2012, 13, right? It was, to me, initially very niche. And I thought, but then I wasn't sure where it would be going. And to be honest, I was relatively ignorant what it actually was. And I was happy in some sense to be ignorant, right? Because then you think that, okay, I don't need to spend so much effort thinking about it. And then actually several of, my students came to me and basically said, look, it's really pathetic that, we are MIT and we don't have a class on, the latest things in fintech and in particular not cryptocurrencies. And then I thought, actually, they're right. And at the time, I was group head actually at MIT of the finance department, as a department head. And I tried to convince some of my colleagues to teach this class, and they said no. And then I thought, oh, shoot, now I have to. And so there you go. This is like my conflict of interest. So basically, so I thought, I thought, okay, if I need to teach it, I need to really know it, right? And I need to understand what it is. And so that's when I basically started learning much more about crypto. I also, in this class, for example, I invited a bunch of people who at the time were really industry leaders in crypto. For example, the founder of Circle, Alea. At the time, Circle wasn't even a stable coin yet. They were just basically an OTC broker, and we had really good discussions, but also, at that time, there was very little formalized knowledge of what crypto was. And so it was, to me, as a financial economist, I suddenly realized, wow, this is actually a very cool space in the sense that intellectually, there's a lot going on. And in a way, there's also some reinvention of finance in that space of people who are engineers and don't know so much finance. And then when you are a financial economist, you think like, I have seen this movie and I'm really scared. I see it crashing and I can tell all these people that it will crash. And of course, they will not believe me. And then you don't want to say, wow, I told you so. But sadly, some of this actually did happen. Yeah.
Yeah, I've seen a joke about that somewhere, about how crypto speed ran all of the lessons from financial economics of the last, 100 years or something.
Exactly.
So based on the research that you've done, and I guess the interactions that you've had in that space as well, do you think that cryptocurrencies have been an overall positive innovation?
I know this is a very loaded question. Let me say, and I'm an economist. So I would say on net, I still feel that cryptocurrencies are still looking for their really big hit application. I wouldn't say the same thing about blockchain. I feel blockchain as a technology for, kind of settlement of trade, maybe for even, kind of settling of international trade contracts and these type of things, has already had and will probably have lots of useful applications. But cryptocurrency, right, as a payment mechanism and as a currency, I feel indeed per se haven't had like a huge breakthrough application yet. However, I do want to say the following. I feel that the fact that there has been so much talk about our payment system, about the inefficiencies of our payment system, about the pathetic fact that, until recently, it took 3 days for a payment from a US bank to another US bank to settle. I mean, this is just unacceptable in the 21st century, right? So I'm saying all this to say that I think one, at least in the US, very big positive thing that maybe inadvertently came, or maybe intentionally, but came from the crypto discussion is that the US has invested in many new payment realms, right, and rails, and many financial service companies, including the credit card companies and PayPal and Visa and blah, 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 are now starting to think much more how to increase the efficiency, the speed, reduce the prices, and so on. And so I think that on that is very good that this has happened. Now, in a way, it's very sad that it took crypto for this to happen, right? I mean, it's just like, come on, right? The technology was there before crypto, but maybe the regulatory appetite wasn't there, the urgency wasn't there. So I do actually give in a way, the crypto discussions a lot of credit for making people much more aware of the inefficiencies of this system.
So it created some competition for existing payment rails, and even if crypto wasn't ultimately the answer, it just the notion of potential competition made existing payment rails get more efficient.
Yeah,
that's interesting.
I think it also made a lot of consumers suddenly much more aware of what they were paying and not wanting to take it, right?
How does the trading behavior of retail investors in crypto differ from their trading in other asset classes?
Yeah. So I would say there's a lot of interesting research that has started to look at the trading, of people in crypto. And of course, kind of there were people who very early invested in, traded in cryptocurrencies. And there were, kind of also big hedge funds and so on that initially made a lot of money through arbitrage trading. So at that time, right, there was still really big arbitrage opportunities. So you might, this is now ancient history, but there used to be this, what was called the kimchi premium. So the same Bitcoin token was available to buy in South Korea, let's say, for $2,000 more than on US exchanges or on UK exchanges, right? And then, of course, so especially institutional investors started and hedge funds started to arbitrage these price distortions away. But actually, some early retail investors did really well, kind of in these things too. Yeah. Now, I think what over time we see has started happening is that as crypto trading has become, in a way, much more broadly available, there are now many more people, in a way, who trade on it. I would say more for the sake of risk-taking than really doing any arbitrage anymore, right? And there, what at least our research suggests is that in crypto, the average retail investor actually is much more of a buy and hold momentum trader, while in other asset classes, say equity or commodities, right, they are trying to be contrarian. So the last thing I said, right, has been shown not just by us, by actually lots of people who have used data from Robinhood, Charles Schwab, other basically discount brokers. And what you over and over see is that in the more traditional asset classes, retail investors try to be contrarian, and and they basically, what does this mean? That means when the price of an asset has gone up a lot, that's when they typically sell, and when it goes down a lot, they buy in, right? So they must have somehow a belief that the market overshoots all the time, and they know better, and that's why they want to be contrarian. In fact, there's very nice research by Enriqueta Ravina and her co-authors at HBS that shows that this type of contrarian trading in stock is in particular around earnings announcements. So, when there is a positive earnings announcement, the price goes up, retail investors then want to trade against it. Yeah. Now, what we see that those same people who trade this way in their equity and commodities, in crypto, they don't do this. When the price goes up, they keep holding and they don't sell. And when the price goes down, they also actually hold, and they don't either necessarily buy a lot more, but they also don't sell. And so it seems, right, people seem to be much more willing to, in a way, endure the market movements in their crypto trading than in anything else.
What do you think explains it?
Yeah, so we, obviously we just see people's trades. We don't look into their brains. We also didn't have a chance we didn't have a possibility to survey these retail investors. I think, so there is work by, for example, people at Berkeley that have surveyed investors too. We think a lot of it is that the return expectations that people have in cryptocurrencies is different from other asset classes. And what I mean with this is that people somehow have this belief that in cryptocurrencies, when the price goes up, they think it's an indication that the price will keep on going up. And some of it is because maybe, they have behavioral biases and they think, oh, the price can only go up. But it's not all irrational, because if you think about, especially in the early days, or we are still in the early days of crypto, right? Because we don't, we all don't have a lot of cash flow information, right? Cryptocurrencies don't yet generate a lot of cash flows. So what do you have? You have, you've only the price to update about the future adoption of cryptocurrencies. Yep. And what we think is going on is that what people basically want to figure out is, will crypto become really big, right? It's already growing, but will it become really big? And what model to put on this is very complex. But when they see the price going up, they say, it means that more people are adopting crypto, more people are trading in it. Maybe it also means that regulators will look more favorable on it, that it's not going to collapse. And so, yes, if that's true, then there will be more positive network externalities and the price will keep going up. And so therefore, I think it's actually not irrational if people think that when you see an increase in the price of crypto, it might also mean that it's there to stay. And therefore, right, the price should be going up a bit.
It's super interesting just that the behavior of people trading in stocks and crypto is different. That alone is just fascinating.
Yeah.
You mentioned earlier being able to bring your financial economist perspective to crypto and see things before they collapse. And you wrote a paper about the Terra Luna collapse. Can you talk about what caused that?
Yeah, what caused that? So what our research suggests is basically that this was a system that was becoming less and less sustainable. And we can go into the details why it wasn't sustainable. Basically there was an anchor protocol, which is that was basically like a money market fund for crypto that was paying out more than 20% in its deposit rate to the people who were depositing funds on this DeFi app, but they were not generating 20%, right, on the tokens, basically on the stablecoin USD. And so then what our research suggests is that over time, a large fraction of the participants in that system started realizing this is not sustainable. And actually that this high deposit rate was being subsidized by some of the investors, the early investors in Terra Luna, and also the insiders who had made a lot of money from the hype in Terra Luna and the fact that the Luna price had gone up so much, right? And so then what we show, looking at blockchain data from the Terra Luna blockchain, is what seems to have been the case, is that there was a trickle of people starting to leave Terra, and I mean also sell UST, the stablecoin that the system had. And then what happened is that a few large investors decided to take their money off the table, so to speak. And then kind of there was a run. But I want to be very careful, because early on, when in the run of Terra Luna, so the co-founders of Terra said that, this was a malicious attack by some outsiders who were trying to destabilize the system. Yeah. Almost like a bank run, right? If you run on a bank that has money invested in illiquid assets that might even be very valuable, right? But if you force them to do a fire sale, then a bank can fail. That is even a solvent bank, right? This is why banking is so difficult. That's why we have the Fed and so much regulation of the banking system and so on, right? But what our research shows is that that doesn't seem to have been the case of Terra Luna. The problem of Terra Luna was basically that there was no seriously productive asset that they were investing in. And with time, more and more people realized, wow, this has to come to an end. And so then it was more a question of who will let the first shoe drop, in a way, right? Wow. Rather than this being a malicious attack. And then what we basically show in the research is that ultimately it was large investors that ran first, realizing, right, now this thing really is going down. And unfortunately, the small and poorer investors were the ones who didn't realize that even a run was already starting. So they kept buying. In fact, they even kept buying from the big guys who were running from the system. And they only ran much later, when the price had already, collapsed quite a bit. And so they lost way more money.
Wow. So big informational asymmetries that affected the smaller depositors.
Exactly, right? And the sad thing is, of course, that one of the promises of the open, permissionless blockchain initially was that everyone, even small people, can see what's going on the system, right? But exactly as you just said, Ben, just having the data is not knowledge, right? You have to have the model to understand what is going on. Is it a run? Is it not a run? In fact, I saw on many, kind of crypto Twitter and the chat rooms of Luna and Anchor during the run on Terra Luna, some people were saying, "Oh, now is the time to buy the dip." So you see, they didn't even understand this was a run. They thought just like, "Oh, now is a good time to buy into it." But that really shows you that they really didn't understand the underlying system that was being created.
Crazy. You'd have to think also that with a project like that, the depositor base would be relatively undiversified just by nature of it being a crypto project, which is like banking risk management 101 to not have a concentrated depositor base.
Absolutely. And, I mean, in particular, I think in Asia, in particular in South Korea, a lot of people lost a lot of money because Terra Luna was, because the founders originally are from South Korea, they marketed it more strongly there. And so from everything, what we studied, they are actually the welfare impact on many retail investors really was very horrible.
Yeah, that's terrible. What do you think the outcome of this thing suggests about the role of regulation and maybe even central banks in the financial system?
Yeah. You see, in the end, right, there is, unfortunately, you can say, but unfortunately, financial markets will always have risk. And in particular, banking has a lot of risk because there are, as we were just saying before, right, banks inherently, if they do maturity transformation, meaning, they invest in long assets, but give you deposits that you can withdraw whenever you want, they are inherently somewhat fragile. And that's why we have a regulatory system like, kind of the central banks, a lender of last resort, a deposit insurance like the FDIC, right? To assure people that they don't need to run when they hear a crazy rumor, right? If it is a regulated bank. So in a way, there is a reason why all these things are in place. And they do protect, in particular, retail investors who, in particular, right? If you think about it, people don't have time to watch their money 24/7, right? They have real lives to live. They have work where they have a schedule, right? You have to be very wealthy to just be looking at your money, to be very honest, right? And so I think what we have basically seen in crypto is that ultimately all these truth, right, that people have been studied, and in a way these repeated things that occur in financial markets also occur in crypto. And just the fact that something is on a blockchain or that it's outside the regulatory framework actually doesn't make it somehow better. It doesn't make it it does not even make it more competitive. That's, I think, the shocking thing that many people don't understand. I hear this all the time, from people who are in crypto, that they say, but look, the one big difference is because it's an open system, it's a permissionless system, anyone can access it, therefore it is more competitive. But that's not true. And the reason it's not true is because financial services, by their nature, have massive economies of scale and scope, and they have network externalities. And so what does this mean, right? What it means is that when you big begets more big in finance. Liquidity, if you think about it, is the ultimate network externality, right? It's basically when you are a big market, even if you charge people a lot, traders will come to you because execution is best in the liquid market. And basically, and that's why if you look even in cryptocurrency, in the crypto world, right, it's Uniswap, right, is still the biggest, decentralized exchange, even though there have been many startups like SushiSwap and other, and many others. But you can see that without any regulatory intervention, naturally, that system actually became very centralized. And it's exactly because of, in a way, the natural law of finance, that economies of scale, scope, size are working. But think about the following, right? When there is no regulation possible, once a provider becomes very big, nobody is telling Uniswap, look, your fees should not exceed XYZ. And in particular, it shouldn't exceed XYZ for really small people who don't really know what they're doing, right? So then actually what you saw, right, you were exactly saying this before, really in a massive fast forward, how a system that was meant to be competitive itself made itself very uncompetitive. And we see this in many of these financial applications in the crypto world.
Oh,
yeah, so interesting. I mean, it happens in finance. It also happens in technology, where decentralized technologies tend to centralize, and crypto is kind of getting that from both sides, from the technology side and the finance side.
Absolutely.
I know we cut out the VCP questions. Can I work one in before we end?
As you wish.
It'll be a general one, so it might be harder to answer, but we'll see what happens. Okay, another area that you've done a ton of incredible research is private equity and venture capital. And I like I said, it's going to be a general question, so I hope it's not hard to answer. For retail investors, what do you think about private equity and venture capital as an asset class?
I think that for most retail investors, it's not a great idea to invest in private equity and venture capital. And the reason is that from a lot of work that has been done over the last 20 years, and I have some very old work with Steve Kaplan that we did, but kind of what basically we see is that in venture capital and private equity, you see massive differences in the performance of funds, way more than in mutual funds or any other, kind of traded asset classes. And so it really matters with whom you invest, right? So it's not just, I can build a diversified portfolio, because the stakes are so big. If you are a small investor, there is no way you can be diversified. You need easily $500 million to be even close to diversified across some, kind of private equity funds. And if you really want to be, kind of in private equity, forget, ventures, the funds are a little bit smaller, but in private equity, right, you need even more. And so that, a retail investor cannot achieve. Now, on top of it, actually, in some more recent work that I've done with Josh Lerner, what we also saw is actually who you are matters in private equity. And this actually goes back even to the discussion we had about financial advisors, right? Which is basically the best private equity and venture capital firms will charge clients based on how valuable they are to the fund. And what we have basically seen over the last decade in particular is that if you are a really big pension fund, right, or the endowment of Yale and MIT and Harvard and so on, so you basically have a lot of money and you have some expertise and you have maybe a name brand, you get into much better funds than if you're an average person. But then we have shown that if you don't get into the best funds, actually the performance is worse than just investing in the index. And so that's why I think, for retail investors, it, left to their own, effect, so to speak, in their 401k, I don't think that's a good idea.
Yeah, that's really your stuff on private equity is obviously incredible research. What do you think about? So you mentioned pension funds. What if we took an ultra high net worth individual investor with a big name? Maybe does that apply to them too?
So there, what we see is basically it really matters how smart the investor is. So, kind of there are some very high net worth individuals who have a fantastic team that, works with them, and they make fantastic decisions and have great returns. And then others, whom don't, maybe, they don't know how to choose their own advisors, or, kind of they just got unlucky, but, kind of we see a lot of differences. But we even see on the pension funds and on the endowments, I was just saying endowments, but the smaller endowments who don't have the money to invest in an expensive staff that can really understand private equity and venture capital well enough, they typically have bad returns in VCPE. While, kind of the pension funds and endowments that are large enough and have over time invested in a good enough staff, they are the ones who have better returns.
Wow.
Let me say, one thing that I worry a lot, and sorry you didn't ask this, but
No,
this
please,
is something that really kind of, you can say keeps me up at night, but it does keep me up at night, is that, you see, the nature of private equity and venture capital and the fact that it's so illiquid means that you can hide bad returns for quite a long time, right? So for 8 years or maybe even 10 years, there is no reckoning, and then there are bad returns. Now, why is this particularly bad for pension funds, but also for endowments, is because if you think about a university spends out of its endowment based on a rule, right, on the endowment returns.
Mm-hmm.
Now, if it's a publicly traded return, if your portfolio did poorly, well, then you don't spend so much, right? But in VCPE, where you can pretend that, oh, we had 12% return for 10 years, and therefore the university might overspend, right, out of its endowment, basically what you're doing is you're beggaring future generations in order to spend today. Now, right, if today's research is brilliant and people do a great job, well, maybe that was good. But if they don't, then I think people need to understand that we are actually de facto stealing from future generation or from the young people today by pretending that we have these great returns. And the same is true for pension funds, right? It's basically we are giving today's pensioners way more, and we're taking from the young, right? And I'm an old lady, so I'm not on pension yet, but right, I mean, but really it worries me that the more we do this, the more we're leaving the young generation to hold the bag.
Yeah, holding the bag is that. I agree with you on private market valuations. We don't touch it as a firm, so it doesn't keep me up personally per se, but I think it's pretty scary. There's an article recently in the Wall Street Journal about private market valuations and how funds acquire private assets for a steep discount to their mark, but then value them in the fund at the mark, and it looks like they just got a really big positive return, which then affects the fund's performance, which then affects investors allocating to the fund. But of course, you can't argue that's a real valuation, I don't think. Anyway, I agree. That's very scary stuff.
This is exactly, again, right, where because the illiquidity allows you to hide a lot, if people don't fully understand these implications, they are not aware that this is happening.
Yeah.
So our final question for you, Antoinette, how do you define success in your life?
So I would say in my professional life, I hope to, kind of through the research that I do, to inform people so that they make better decisions for their life, and that, we improve how markets function, how finance functions, so that financial services really serve people rather than, basically are just a way to extract rents from, kind of helpless retail investors and people in general. In life, I think it's more complex. You hope to be a good person to the people that, you are around, and have a positive impact on them. And that to me is very, very important. But, it's an ongoing struggle, I think, for the rest of one's life.
Great answer to the question. All right, Antoinette, that's our last question. This has been a great conversation. We really appreciate you coming on the podcast.
Thank you very much for having me. It's been lots of fun to talk to you.
Such a great conversation. Thanks, Antoinette.
Thank you. Take care.